Welcome back, financial enthusiasts. Today, we're diving into the dynamic world of growth ETFs, your ticket to investing in some of the market's most promising companies. This will be an intro to growth ETFs, so whether you're a seasoned investor or just starting out, understanding these ETFs can be a game changer for your portfolio. Now, please note that this video is for informational purposes only and should not be considered financial advice. Always consult with a financial advisor before making investment decisions. Now let's get growing. First up, let's talk about the Invesco QQQ Trust, ticker QQQ. This ETF tracks the NASDAQ 100 index, giving you exposure to 100 of the largest non-financial companies listed on the NASDAQ stock exchange. Think tech giants like Apple, Microsoft, and Nvidia. Over the past year, QQQ has delivered a return of approximately 25.61%, with a 5-year annualized return of about 19.93% and a 10-year annualized return of around 18.34%. The expense ratio stands at 0.20%, and it offers a dividend yield of about 0.54%. To put this into perspective, let's consider a real-world example. Imagine you invested $10,000 in QQQ a decade ago. With its 10-year annualized return of around 18.34%, your investment would have grown to over $53,000 today, showcasing the power of long-term investing in growth ETFs. Now, if you love QQQ but want to save on fees, meet its cost-effective twin, Invesco NASDAQ 100 ETF, ticker QQQM. It tracks the exact same NASDAQ 100 index, holds the same companies, and performs nearly identically to QQQ. So, what is the difference, you may ask? A lower expense ratio of just 0.15%, compared to QQQ's 0.20%. Over time, that can save you a lot in fees. Performance-wise, QQQM has had nearly the same returns as QQQ since its launch, with a 1-year return of 25.57%. The dividend yield is slightly better at 0.59%. Since its inception in October 2020, a $10,000 investment in QQQM would have grown to approximately $18,298 by the end of 2024. So if you're a long-term investor and don't need intraday trading flexibility, QQQM might be a smarter move over QQQ. Why pay more in fees for the same investment? Next, we have the Schwab U.S. Large Cap Growth ETF, ticker SCHG. This ETF focuses on large-cap growth stocks, including top holdings like Microsoft, Amazon, and Alphabet. Over the past year, SCHG has returned approximately 27.38%, with a 5-year annualized return of about 18.53% and a 10-year annualized return of around 16.58%. It boasts a low expense ratio of 0.04% and offers a dividend yield of about 0.41%. With a 10-year annualized return of approximately 16.58%, an investment of $10,000 would have grown to about $41,800. With SCHG, you're investing in established leaders with a track record of innovation and growth. Moving on to the American Century Focused Dynamic Growth ETF, ticker FDG. This actively managed ETF targets high-growth companies across various sectors. While specific performance data isn't available due to its recent inception, FDG has shown promising returns since its launch. The expense ratio is 0.45%, and it does not offer a dividend. FDG provides a diversified approach to capturing dynamic growth opportunities in the market. FDG was launched in March of 2020. A $10,000 investment at its inception would have grown to about $14,500 today. Now, let's discuss the Fidelity Blue Chip Growth ETF, ticker FBCG. This ETF invests in blue-chip growth stocks, including many of the Magnificent Seven tech giants. Over the past year, FBCG has delivered a return of approximately 31.71%. The expense ratio of FBCG is 0.59%. FBCG offers exposure to well-established companies with strong growth potential. FBCG was launched in June of 2020, so we don't have a 10-year time frame. However, if you invested $10,000 at the ETF's inception, your growth would be approximately 60%, and your $10,000 would be about $16,000 today. Last but not least, we have the Vanguard Growth ETF, ticker VUG. This ETF tracks the performance of the CRSP US Large Cap Growth Index, including companies with the potential for above-average earnings growth. Over the past year, VUG has returned approximately 26.54%, with a 5-year annualized return of about 17.32% and a 10-year annualized return of around 15.97%. The expense ratio is 0.04%, and it offers a dividend yield of about 0.45%. VUG provides broad exposure to large-cap growth stocks with a low expense ratio. VUG's 10-year annualized return is approximately 15.97% growth. A $10,000 investment would have grown to about $41,000 today. Not too bad at all, I'd say. In summary, growth ETFs like QQQ, QQQM, SCHG, FDG, FBCG, and VUG, and other growth ETFs offer investors exposure to companies with strong growth potential. They provide diversified portfolios, strong historical returns, and focus on high-growth sectors and companies. But remember, while past performance doesn't guarantee future results, these ETFs have demonstrated resilience and potential in the ever-evolving market landscape. I hope you've gained some insight from this video. I thank you for joining us on this journey through growth ETFs. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insights into the world of investing. Until next time, happy investing!